Welcome the session chairman, CA Mithilesh Sai, with a group bouquet. Now, I welcome Madhu Teja to please come on the stage. I request Taxation to welcome Madhu Teja. Jemin R Patel to please come on to the desk. I request the Secretary to welcome him to the podium. Now I welcome Yash Gupta. I request the Secretary to welcome him to the podium. Sir, you please take also.
Advisory and litigation. Mithilesh is a chartered accountant and lawyer by profession. He holds a certification in international taxation and forensic audit. He is a key business person of SICASA for international taxation and transfer pricing matters and also a co-opted member of committee on international taxation of ICAI. He is a secretary of Hyderabad Chartered Accountants Association. He is an experienced at transfer pricing, advisory, documentation and representations, filing advanced pricing agreements, APA, bilateral and unilateral applications and related assignments, global transfer pricing review of MNCs, planning and implementation of DEPS, pre-tax documentation, covering country by country reports, master file and local file, international tax, inbound and outbound advisory in the area of Indian taxation, international tax and double taxation avoidance agreements, US, UK, Singapore taxation, advising clients on managing their tax structures, including outbound investments, evaluation of alternative cross-border operation structures for MNCs, transaction tax and corporate tax advisory to clients in technology, pharma, construction and real estate industry in relation to tax, FEMA, SEBI and stamp duty regulations, tax due diligence for various listed and unlisted clients and liaising with statutory authorities, bankers, lawyers, company secretaries for various clients. He got an expertise knowledge in litigation handling, represented more than 50 criminal appeals before Hyderabad ITAP and made more than 100 CITA and DRP filings and representations. Core experience in providing transfer pricing advisory to MNCs, 150 plus TP compliance and 50 plus TP litigation support, performing compliance support and providing virtual CFO services to more than 100 plus companies, regular speaker and presenter of discussion papers on various topics in international taxation, transfer pricing and regulatory matters, performing leadership role in a forum with almost around 100 people in Hyderabad. Thank you, sir. Over to you.
Yeah. Please stop there. So please channelize your energies in listening to the topics. So this is a very important topic. Tomorrow, all of you will be charged on. So I like the energy. but this energy should be channelized into listening and grasping that. I don't know how many of you would have watched Balakrishna's interview. Anni chesi ikkadiki vachi kuchunnaaru. We have done that, and after 15 years we are standing here. So the point that I am trying to tell you is, please channelize, be disciplined for the next 1.5 hours. I think people will be having a lot of butterflies in their stomach if you keep shouting like that. So let them present peacefully. This is a very, very important topic, and a very important topic tomorrow if you want to practice, tomorrow if you want to go into consulting, tomorrow if you want to go into Big Four. This topic is the key. So please listen to the concepts and let them talk. Thank you.
Yeah, we'll go with the first topic on double taxation treaty. Tax havens. First topic will be tax havens. Very good. Tax havens will be dealt by Yash Gupta.
Namaste. Cooperative Agriculture University and currently in Foundation Madhu. I thank each one of them to give this wonderful opportunity. Good afternoon to the dignitaries on the stage, off the stage, and the wonderful audience. Let's clap for all these as well. Now, I am going to present a paper on the topic tax harmonization. What exactly is tax harmonization? Now, I also want to imagine two questions which are occurring in the screen right now. Why is taxation conducted only in UAE when there are 107 other countries as members of ICC? Well, there are very good answers that I cover this in the course of the PPT. The second question is, what is the similarity between all the three MNCs which are appearing on the screen right now? Morgan Stanley and Goldman Sachs. What do you guys find the similarity between these MNCs? Yes, exactly. That is the service they provide. And what are the other things for the similarity in these MNCs? That also I will cover in the course of the PPT. So let's start. I will be covering the following types of topics. What exactly is tax haven? All the countries covered in the tax haven. What is Indian taxation versus foreign taxation? Next topic, what is exactly double taxation avoidance agreement, on which my friend Madhu will also guide you somehow. And the other thing is live example of MNCs, like how exactly MNCs are using this culture and getting the tax save, earning around crore and pay minimal taxes. Next topic, offshore entities. We have written a lot about this. Like we have written Panama papers, so many scandals. Getting the entities in Dubai, Foreign, Australia, Mauritius, South Africa, whatnot. But what exactly is this step? Let's understand that part of it. And lastly, what exactly is transfer pricing? So in any cases, guys, what exactly is tax haven? That's a big answer. I thought the same answer would be there. So I thought is zero taxes would be the answer. Are you excited to know more about this? So this is a chart which shows exactly how much taxation is there in so and so countries. Let me brief you some of the countries in which there are minimal tax. It is not zero tax, it is a minimal tax. Like the countries will not charge corporate tax, but they will charge payroll tax, or income tax, or property tax, or social security tax, transaction tax, whatnot. Like they will tell you only that there is no individual tax, but they will collect taxes you in some of the other way. Like if I tell you there is no corporate tax for you, but if I tell you there is a payroll tax of 80% to 40% depending on your income, what will the people of the nation? It's the benefit to corporate the government is providing to promote the employment in the country. So that's not the case. It's not zero tax. It is a minimal tax to the corporate. The countries are giving the benefit to that corporate. Coming to Jemin Islands, we have reserved this Jemin Islands many a time. Many of the offshore entities, Fortune 500 companies are setting up subsidiaries in that country. Why only Jemin Islands? Because the corporate tax in that country is 0%. Yes, you must be right, it is 0%. But other things, I am saying that there are payroll taxes in that country ranging from 8% to 14%. There are social security taxes in that country as well. Other taxing nations are Hong Kong, Mauritius, Switzerland, Jersey, Panama. Yes, we are thinking that these are tourist places. We have heard many times of Switzerland, Hong Kong, Mauritius. These are absolutely very good tourist places as well. But we have seen many good MNCs set over in these countries having their joint associates, subsidiaries, holding companies set over that country. But we can see the business is running over in India. Now let's understand the country-wise definition, like what exactly the country is providing and what exactly that country is known as tax haven. British Virgin Islands is holding 5,000 times more than its FDI. Like suppose if I tell you that ₹100 invested from foreign in British Virgin Islands, but it has 5,000 rupees worth as investment from foreign. Like if it invests ₹1 in outside market, it is getting 5,000 rupees from domestic market itself. So like if I tell you, if I give her ₹1 and you are giving 5,000 rupees instead, so who is winning here? Me giving ₹1 and you give me 5,000 rupees back. So I am getting benefit of 4,999 rupees. The same thing British Virgin Islands is here having, holding 5,000 times more than its foreign direct investment. Coming to Cayman Islands, I already stressed on this. It is home to subsidiaries of 4,500 companies. Like we have results from MPBC also. Getting to 4,500 companies is a very good thing. Like you have to have revenue so many, like you have to be the top 100 companies of nation having global network. So that is the thing. Cayman Islands is having subsidiaries, many subsidiaries of Amazon, Flipkart, Walmart, Goldman Sachs, and these are the nations which are having subsidiaries in that nation. Coming to Switzerland, it is also known as secrecy of banking sector. Now if I say that you invest in my country and I leak this information to your nation, then you might be taxed in your nation. So I will want to get benefited by investing in your nation. So we have to provide the secrecy. There are also other laws that we are covering in the course of the PPT. The secrecy of this information is very, very important. And Switzerland is known for secrecy of banking sector. UAE, there is no personal income tax, no capital gain tax in that country. So there are many corporates in that country benefiting the employees rather than corporate. We can see MNCs are not having subsidiaries over these countries. Like larger parts of the MNCs are not having subsidiaries. There are few MNCs which already have set up there, but they are planning to move these MNCs to some other country where the corporate tax rates are zero. According to the survey conducted in 2020, Corporate Tax Nation Index, the lowest tax rate was 0% in Jemin Islands. They are every year the index is going to change. Like they will be conducting survey, they will be having the tax paid by the corporate. They will be dividing the number by the revenue, and the index is arrived. So the lowest index is they are found in between Jemin Islands, which I will show you exactly is located in the course of PPT. In the Jersey, which is located in UK, there are no property taxes in this country as well. Now let us compare what exactly is Indian taxation and versus foreign taxation. Now if I say this, if tomorrow Honorable Prime Minister Modi comes and says, भाइयों और बहनों, मेरे प्यारे देशवासियों, और रात 8 बजे से जो आप पे टैक्स लगेगा, वो खाली 20% पे लगेगा. अभी जो सरचार्ज लग रहा है, जो सेस लग रहा है, वो सब निकालूंगा मैं. वो सब निकाल के मैं कॉर्पोरेट को टैक्स करूंगा. How will I be happy listening this statement from him? Like I will convert English into Hindi. I think you guys will get Hindi. I told that tomorrow Modi comes and tells this that the maximum tax which I will provide on individual is 20% and capping the tax rate at 20%, removing all the surcharges, removing all the LGC and taxing more on the corporate side. How many of the individuals will be happy listening to this statement of Honorable Prime Minister Mr. Modi? Like no one will be happy. Like we exactly know how Modi will be planning the taxation, giving the benefit here and taking some of the benefit from us, and in the net we will not be getting much more benefit in the statement also. So this is the thing. Lowest corporate tax possible in India is 17.472% according to section 115. but lowest corporate tax if possible, the tax eliminations are 0%. So this is the problem of it. Like this, I'm not the problem. There are some challenges why we are not getting holding subsidiaries in India. Like we have MNCs in India, but there are not at such big level which are operating in other nations as well. Other thing is foreign income is chargeable in India according to section 5 and 9. That is place of effective management. If it is in India, the tax you need to pay is in India. Also, you earn the income in foreign. Other thing is, I already told there are no property taxes in the country of Jersey. Now, if you are paying for, if you are doing transactions in foreign currency, obviously RBI will be coming and they will be setting some guidelines. So let us now understand that part of it. What exactly are the RBI guidelines on this part? State Bank of India is authorized here, set up by the Indian government. Like it will also monitor how many funds are being received from foreign, and then from State Bank of India you can dispose this from multiple nations. But according to FCRI Act, the only authorized user is State Bank of India. Like if you want to receive funds from foreign, you need to have State Bank of India account, and from that account you can transfer this money in different accounts. Now let's understand what exactly is utilized in this remittance scheme. RBI's cap the number of limits and number of transactions you can do with the foreign nation according to the country. It has $250,000 per year per person, which accounts to rupees 2 crore rupees. So you have a maximum capacity of 2 crore rupees per person in a year. You cannot exceed this limit. Like if you have to use some other corporate dealings, or you have to use the name of some other person to remit the money towards outside, or you have to receive it. Now coming to foreign currency rate, everyone know that Indian foreign currency is decided according to fluctuations like demand and supply of foreign rates. So when we are dealing in foreign currency, demand and supply also changes. This will definitely affect the foreign currency. Now let's have clear the picture. What exactly differences or how many countries have which tax rate, so that they are called tax elimination. Now let's focus on this slide. Coming to this part of the slide, there are no personal income taxes in these countries. That is British Virgin Islands, Cayman Islands, UAE, Bermuda. They don't charge any personal income taxes, and that means that you need not pay a single rupee as a tax when you are earning in individual. Now coming to the second part of it, there is no capital gain tax. I already mentioned the Finland side, if you remember. Switzerland, Hong Kong, Jersey, Singapore, these are all the countries in which there are no capital gain tax. Plus, all the countries covered in the no personal income tax rate. These are also the countries in which there are no capital gain taxes. Coming to no property taxes, it's Cayman Islands and Jersey. So I think you guys know why is UAE selected only the venue of IPL rather than other nations. Like if you guys Google it, IPL income which is earned in India is also exempt from tax. If you don't believe me, you can Google it right now. The income earned from IPL in India is exempt from tax. Then why will BCI take something forward and pay taxes in some other country? So that's why UAE was only selected as the venue for IPL 2020. Now we will be surprised to know these are the benefits of tax elimination. What exactly is the role of CA in this field? Now let me focus on that part. International taxation. Like you will be giving advisory to the client how exactly he need to set up the entity. Like if you plan to set up the entity in India, what is the tax rate? If you plan to set up the entity in Jemin Island, what is the tax rate? If we plan to set up an entity in Jemin Island instead of Australia, then what exactly is the benefit of out of these two options? That is the scope of CA in this field. You will be hired for this services, and you will be expected to give the solution, and you will be expected to give a result. What exactly is the comparison between these two countries? Setting of offshore entity. For this, you need to tie up with lawyers who will charge 10,000 or in lakh rupees for setting up this offshore entities. But there are many famous lawyers based out of Mumbai who are already famous in this field and known only for setting of offshore entities. They will ensure that all the taxation laws, all the foreign laws, all the laws in that countries are properly complied, and there is no other thing which is left out to carry on smooth businesses with chartered accountants. Coming off next, compliance of law. Like we already, you guys are already passed inter. You are studying it, okay. So in the course of study, in the year subject, you will learn about the IT Act, PMLA Act, FCR Act, FMI Act. In that you will be coming to know that there is data secrecy, privacy policy, and what exactly SPDI. SPDI is sensitive personal data information. You cannot leak any sensitive personal information which you have for other corporates or to anyone. So that part of thing you have to comply as like what exactly the data is getting generated by you and how you provide the data secrecy to the client. How client is assured to give the data to you without having any second thought. Next one is merger and acquisition. Like if I ask you, you have a good textile business in India and for not textile business, automobile business in India, and we know the automobile market is in Japan. So you came to know that in Japan, one of the unit has going to be shut down because of many reasons, and it is getting in lowest degree possible. So you will be interested to have a unit in Japan as well. So you will be interested to acquire that unit and have a business in Japan as well as India, so that you will have global presence. But you will be confused that in Japan they may be the taxation rate might be more, and if I acquire Japan unit, the balance sheet I need to make in Japan currency, then I have to merge that balance sheet in Indian currency. There are foreign currency fluctuations, there are finite regulations, so many the client will not be interested to know this all thing. So they will just hire a CA and they will just looking for the consultancy services, how to get the tax saved by acquiring that unit. So you as a CA working there, you will be working on this field merger and acquisition. How exactly is that merger or that acquisition of the company beneficial to the company in the business or in the coming decade? So I already spoke on this data privacy. It's a very important thing because we are in such a profession that each financial information when get into the client, every information of financial is very important, and we cannot go on share to some other people. We have to be very authenticate. We have to be very authorization to give some information outside. So there are total 88 double taxation avoidance agreements entered, which India has entered with foreign nations, out of which 85 are in force right now, and entered with tax haven countries with Mauritius, South Africa, and many other taxation. But these are the countries which India uses the most as DD company. Now this is a slide which we can see the tax haven nations are covered around the world. You can see in Asia there is Hong Kong, there is Switzerland, and this Jersey comes in UK, there is Mauritius, and this is Panama. Let me stay on this Panama. We have already heard about this scandal, Panama Papers. We have heard Aishwarya Bachchan, Abhishek Bachchan name coming out in it. What exactly happened in that case? I will not stress more. I just brief out you that. What happened is the names of these persons were leaked in that papers. So only Indian government got to know that they have invested their money in that country, and since the data is leaked, Indian government got hold of them and told to remit all the situations like how exactly the holdings are there in different countries, and started to change the taxation accordingly. Now let's understand how MNCs are getting benefited out of this. Now let us know the Vodafone MNC. It has subsidiary set up in Cayman Islands. The government of India has changed its taxation laws time to time from retrospectively, not from prospectively, retrospectively from 1962 to get the Vodafone case into taxation picture of Indian taxation law. But at the end, the Vodafone company ended up paying no tax on that case. Coming to Amazon. What Amazon did exactly is, it has changed its holding subsidiary unit, which is based out of Chennai, to Singapore. Why? Singapore is a tax haven nation. They ended up paying much taxation in India. Doing this, it has saved crores of rupees as tax expense. Coming to Walmart. We all know that Walmart is a great MNC, having the commodity, very great deals in the commodity business. But why exactly there is no holding company of Walmart in India? The situation is the same. The answer is the question to the same thing. That India does not support to operate that level. I have already shown you that slide. 17.472% is the minimum tax rate corporate has to pay in India. That also we have to follow so many provision section bylaws to get into that section. Google. We all are using Google day in and day out. But Google has only subsidiaries in India, but not holding companies. Why? The sample is same. Indian tax, Modi does not support lower taxation to the corporates. Other laws, PAMLA. What is PAMLA? PAMLA is Prevention of Money Laundering Act. If you say that you are having, there are three stages to it: labeling, anti-laundering. So if you have there are three structures to it. If you set up the business to it in India, then you have subsidiary in Mauritius. So in that Mauritius country, you have subsidiary in some other country known as Cayman Islands. Over there is a transaction tax here. Let us understand. If you send the payment to Mauritius subsidiary, and from Mauritius subsidiary you send the business to Cayman Island, it will come under labeling. Like you are wanted trying to infuse of funds in many of the countries, and then the cycle is getting rotated, but there is no infuse of business. These are some of the main standards. European Union, which is the main having in the European nation, has blacklisted some of the countries. And if you invest in that countries, the data will be leaked out, and the countries will be knowing what exactly, how many people have been invested, how many rupees have been invested, what time have been invested. So you cannot have business, you cannot have subsidy, you cannot have associate in that country. So European Union has blacklisted some of the countries in that part. So I want to say this one thing that इतिहास लिखने के लिए कॉर्पोरेट यूरो चाहिए लेकिन कलम नहीं मीनिंग दिस लाइक राइटिंग हिस्ट्री यू नॉट रिक्वायर पेन यू ओनली रिक्वायर करेज सो हैव करेज एंड लेट्स क्लियरली डिस्कशन थैंक यू वेरी मच
Yeah, so that was brilliant presentation, sir. Very good. So a lot of energy, a lot of clarity we got. But there are few things that I just wanted to say on tax havens. So don't look at tax havens as a negative aspect. So all the governments, including Indian government, know that tax havens are there and 0% or low minimum tax rates are being deployed. But the point is, these aspects are also to be looked at for economic development. Say suppose UAE, Singapore have grown on this particular base concept of tax havens. So our country has also reduced corporate tax rate from 30% to 17% and even 15% for manufacturing entities right now. So the world is going towards reduction of tax rate to encourage more and more tax compliance and at the same time economic growth rate. Other point that I just wanted to talk about is the mostly the tax havens, as you rightly mentioned, the base havens, static havens and special communities are there. But the point that we have to understand, what does people take advantage of this tax havens? How do they actually implement these tax havens in their tax structure? So mostly the tax rates, as he mentioned, personal tax, corporate tax, capital gains, and these are the things that various countries have deployed. But globally, there is a concept called as base erosion and profit shifting that is going on by the G20 countries, the top 20 countries. So what they are planning to do is, any country which has less than 15% tax rate will be subjected to a negative list. So they will not be encouraging trade with that particular country. So even UAE recently has announced 9% corporate tax rate from June 2023. So UAE is not zero anymore. Personal tax is not there, capital gains is not there, but corporate tax rate they have gone to 9%. So indirectly, all the governments are pushing the companies and pushing the MNCs to give tax at minimum 15%. So all these countries that we are just looking at, they are all below 15% at the moment. So all these will be pushed in the next 2-3 years to come up to 15% minimum tax rate. So this particular aspect of corporate tax rate, the top 10 tax haven countries, is, if you see, only Cayman Islands and Lebanon are there above 15%. Other than that, everything is below 15%. So this particular aspect has to be understood. So other than that, the top global companies, if you see, their effective tax rates are very, very low. So mostly if they are earning $1 million, they are paying tax only on 14% of the $1 million. So they are avoiding tax on most of the money that they are earning through the global structuring through these countries. So the effective tax rates of these countries is being planned by using the tax haven countries. So the structure wise, if you see, these are the basic structures that people follow. So parent and wholly owned subsidiary branch, step down investment in the sense a regional holding company, Singapore, Dubai, Cayman Islands, everything will be a regional holding company where there is no capital gains tax. So they want to hold all the subsidiaries from the regional holding companies where there is no capital gains tax, and the operating companies where there are good resources, man material, labor, and the tax rates are very low, so they want to capture the operations in these operating companies. Capital gains, regional holding companies. Other famous structure is a double investment, where the super holding company capital gains, regional holding company will be IP exemption. So there will be a lot of patents, there will be a lot of the intellectual properties which these MNCs will be holding. So they want to hold in any regional holding company where the exemption towards royalties is there, exemption towards transfer of IPs is there. So they will select companies which are having IP exemptions in regional holding companies other than the capital gains exemption, and they will try to structure their effective tax rates by using these kind of structure. So the overall perspective, if you see, this is how it is going to look like if they are going to structure double investment strategy. So it's very confusing, but I'll just say it very simply that they are going to exempt the capital gains, they're going to exempt the IP laws, they're going to exempt the royalties, they're going to plan the operation companies at a very, very low tax rate. By planning these structures in this way, the tax havens are there in between, if you see. So whatever he just mentioned theoretically, this is how they are going to implement that, and they are going to reduce the effective tax rates. So this is a practical example or a structure. Tomorrow as chartered accountants, you will be asked to structure with very, very low effective tax rate. I'll be dealing day in, day out with a lot of CFOs who hate to pay tax. They just say I will pay only 5%, 10% of the overall revenue. But there is a thin line of difference between tax planning and tax evasion, all of you. So please bear that in mind and always help out them in doing the right thing but not avoiding or involving any criminal activities. This particular aspect of structuring, the government has been very, very vigilant about this structuring. So they have come up with a lot of initiatives which I will talk after the DDA session is over. So they have come out with almost 6 to 7 initiatives to curb the tax planning and tax treaty planning around the tax havens. And we'll go to the next session. He raised all the questions on the tax planning through the tax havens. Now we'll give the solutions through the DDA. After that, we'll plan the initiatives taken by the Indian government as well, so that you get a holistic approach. Go to the next session.
Yes, next session by Madhu Teja on double taxation.
Hi ladies and gentlemen. Today we are discussing about that is double taxation avoidance settlement. Before moving into it is necessary to know about the double taxation. So what is double taxation? Yes, double taxation is nothing but the imposition of taxes on saved income at two different point of times. So, in two cases, DD is applied. In first, here there are two cases, in jurisdictional and economic. In jurisdictional case, the same person is taxed twice on same income in more than one country. But in economic double taxation, here different persons are taxed twice on same income. Here simple, the difference between the number of persons involved. In jurisdictional, the persons are one, but in economic, there are two persons involved. So let's take an example. For example, Mr. Trump is a resident in US. He invested in India and he gets income from India after deducting TDS, and he must liable to pay tax in US again. In economic double taxation, let's take an example. Bahubali is a one of the shareholder, and in the assessment year 2023, company gets a profit of rupees 1 lakh, on which tax has been paid, and company declares rupees 5,000 as dividend. As a shareholder, Mr. Balladeva is again liable to pay tax on that dividend. So let's go into the what is DDAA. So to avoid double taxation, in 1920s, double taxation avoidance agreement is introduced. So, in double taxation avoidance agreement, it is an agreement between two countries to avoid double taxation. So, here we will just discuss the basic questions of what, why and with whom. So, what is double taxation avoidance agreement? DDA is an agreement between two countries to avoid double tax. Why DDA is required? To promote investments from foreign countries, or to raise, to avoid tax evasion, and to encourage honest taxpayers. DDA is required. And with whom India having DDA? Around 88 countries India having DDA, but presently 85 countries are in force. And instead of the 8 limited agreements are also with India. What is purpose of DDA? Purpose of DDA is also the same as why DDA is required. But here it explains like it increases the transparency and it encourages the honest taxpayers like that. What are the advantages of DDA? Here the advantages are simple. The DDA is introduced to avoid the double taxation. So the word itself is an advantage. So here the main intention of DDA is to make the country attractive for investments. So it also offers the concessional tax rates. So what are the disadvantages? There are only 2 disadvantages for the DDA which we all like it. The first one is 3D shopping and another is round tripping. In 3D shopping, where a resident of third country comes and to obtain benefit of double taxation avoidance agreement in 2 different countries which are having the DDA. And in round tripping, like if a investor in India wants to invest, he first take a shell company and she transfers his money to a shell company and again he rotates that money to the India. So he route the investments from home country to another country by avoiding the tax at home. So what are the stages in DDA? In every agreement there are some stages, right? If we are going to plan a new agreement, then first we want to negotiate, where 2 countries come together and the representatives are first the terms should be they are knowing, and then they will cooperate each other, and then they are drafting the articles and signing on it, and then they get approval on that agreement, and after that it is officially announced that DDAA between two countries are official. So there are limited agreements also. For example, India and Pakistan have a limited agreement, that is, if there is any shipping or air traffic profits, there is DDAA applied only. Instead of that, if there any profits occur, it is then DDAA is not applied. So what are the models of DDAA? There are two models. Whenever two countries come to a DDAA agreement, first we get a right which country gets the tax amount. So based on residency, and based on source of income, they are getting the tax amount. So based on residency, as per OECD model, it will get, and based on source of income, the another one is get. So these are the two sections which are in the Income Tax Act 1961 to explain the DDAA. So what are the methods of DDAA? So if two countries in the agreement of DDAA, first one is they are getting the exemption method, because in that method one country is paying the tax and another one is not paying the tax. This is the advantage of entering into the DDAA. If we have so many countries, almost 190 countries in the world, but India having 85 countries with the DDAA agreement. So in that countries, for example, India having the DDAA with the US, UK, etc. So if we are getting anything from US, for example, Trump is getting income from India. So he is first, if we both countries are in DDAA agreement, so either he can in the US or India. If he pays in US, he is not liable to pay in India. If he pays in India, he is not liable to pay in US. So out of these, if there is so many countries, India is not having DDAA with. So in that countries, credit method is applied. So they in one country, for example, Trump gets income from India. In India, tax rate is 30%. In US, tax rate is 40%. Trump pays tax in India 30%. If Trump pays in US, he is getting an exemption of 30% only as a tax credit, and he is liable to pay tax of 10% only. So there is another method instead of these two, that is tax sparing method. So tax sparing method is nothing but a tax treaties between contracting states which give benefit to the residence country to give credit not only for taxes actually paid in the source country. So for availing this benefit, from now we are talking till now we are talking about the theoretical aspect. Let us talk about the practical aspect. How to avail the benefit of DDAA? So to avail the benefit of DDAA of a non-resident, he must have the tax resident certificate or 10F form to avail the benefit of DDAA. What is the duration and rates of DDAA? So there is no specific duration of DDAA. So whenever the two countries in the DDAA agreement, if they want to terminate, then only DDAA is cancelled. And what is the rate of DDAA? Rate of DDAA is nothing but the rates, TDS rates of interest earned between the DDAA countries. It is mostly 10% or 15%. So I would like to conclude this like that's the magic of double taxation That's it. Thank you for giving this opportunity.
I think most of you would have understood the relevance and importance of the double taxation avoidance agreement. The point is, these DTAs are the treaties between the countries. I mean, India, US, India, UK, India, Dubai, India, Germany, India, Switzerland. As he mentioned, there are about 83 to 85 DTAs that you have to read and go through. But the point is, the overall concept of the DTAs, if you ask me, relies on the basic income tax provision. First thing that I don't know how many of you have gone through the Income Tax Act yet, or you have passed the IBCC exam, but this section 5 is the determinant accept. Whether you are a resident or a non-resident determines your taxability first in the country. Then whether you will be giving the taxation rights to the other country through the economic or jurisdictional tax rates will be the key. So first you have to check in India what is the taxability applicable for any transaction. It might be inbound or it might be outbound. First, what is the taxation of India? It may be for the residents, it may be for corporates also tomorrow. So first, always check your taxation in India and then try to go to the DTA. So DTA applicability also will be given as an option to the taxpayer. Either he can take the beneficial provision, whether it is in Income Tax Act or in the DTA, whichever is beneficial, you can take it as per your benefit. That option is always given to you. So you need to first understand the taxability in the Indian Income Tax Act and then the taxability as per the DTA. So DTAs generally are having 28 articles among them. So these are the 28 articles or 26 articles that we are talking about. So mostly in every DTA, in every double taxation avoidance agreement, you will find these articles. So scope provisions, definition provisions, elimination of double taxation, anti-avoidance, substantive provisions and miscellaneous provisions. In the substantive provisions, all the income or the sources of income will be discussed. They will be giving the taxation rights, whether the resident country is going to tax them, whether the source country is going to tax them, and the terms and conditions of taxation for each of these source of income will be discussed in that particular article. So it is very, very important that you read at least 2 or 3 DTAs and understand the substantive provisions so that the taxing rights can be properly understood. So he very nicely explained the DTA concept as such, but if you have to take that to the practicality, you need to understand the substantive provisions. Very, very important. So the point is, first you have to check the sources of income taxation, what does it say as per the Income Tax Act, what rate, what terms and conditions, and then go to the DTA and check these things. Then you can apply whichever is beneficial. So it's not hard and fast rule that you have to take only the Income Tax Act or the DTA. Whichever is beneficial, the taxpayer or the assessee can take that. So the point is, these provisions are very important and the scope provisions are also very important. What exactly is covered, what exactly is not covered, when, from which date this DTA is applicable, all these will be covered by the scope provisions. So the point is, elimination of double taxation, as it was mentioning, exemption method, credit method and all, you will find it in 23 and 25. So these are the sources, the country of residence, the country of source, and the taxation. How is it going to be as a practical example? So there are only 2 confusions for everybody. Where to tax it, whether it is in country of residence or whether it is in country of source. If you have earned income in Dubai, but you are a resident of India, where exactly it is to be taxed? Whether it is to be taxed in India or Dubai, it depends upon your residency. So if you are a resident here in India, global income gets taxed here in India. So like that, the concepts have been summarized here. So So the country of source and country of residence is very important. There might be triangular situations also where the properties are there in some other third country. Those are complex situations. But the point is, allocation of distribution of tax rights is the key for the double taxation avoidance agreement. So there is another recent concept on the DTA which is called as multilateral instruments. So as I was mentioning for the tax havens when he was talking, there are a lot of action points which the government is taking up off late. There are concepts called as notified jurisdictional areas where the government has notified Cayman Islands from 2013 to 2017. It's almost blacklisted kind of a situation where if Indian entities or Indian taxpayers are dealing with Cayman Islands, all the transactions will be covered under transfer pricing provisions. They will be deemed international transactions and deemed associated enterprises. Whatever expenditure that they have to book with Cayman Islands has to be substantiated with relevant documentation, and any income which the Cayman Islands entity is earning out of India will be subjected to a highest possible tax rate of 30% or 40% depending upon the income tax rate. So that's how they have notified certain jurisdictions also. This is section 94A which talks about the notified jurisdictional areas for the tax haven countries. So that is one of the initiatives which the government has taken. Other than that, I was talking about the base erosion and profit shifting, 15 action points which the global, the countries have been taking. These global countries, once they have initiated the 15 action points, one of the action points is the multilateral instrument, which talks about the amendments, which talks about the changes which have to be done to the DTAs. DTAs are all agreed maybe 5 years, 10 years, 15 years back. So as per the recent changes in the tax economy or tax jurisdictions, they have made amendments in certain aspects of permanent establishment, taxation rights, virtual digital asset. Most of you would have heard about cryptocurrency taxation being brought into India. So these are all aspects of the BEPS action plans globally, which have been brought into India. So one of the important illustration or one of the important demonstration of adoption of the global changes is the multilateral instrument here in India. So the amendments to the DTA are called as the multilateral instruments, which have made most of the changes for the DTAs. Other than this, there are also initiatives taken by the government on the tax information sharing. So there is a concept called as TIEA, which is called as Tax Information Exchange Agreement. So this particular concept was initiated by Modi government, which said that if they want any information from any of the specific countries which are signing this TIA agreements, then the information has to be exchanged, especially with countries like Switzerland, where there is secrecy of information for the investments that are being made in Switzerland. They have been pushing them to give all the information across. So this TIA is very famous, and they have been implementing that for China, Singapore, Switzerland, America. There are a lot of companies where they are government. Other than that, there is also concept of CBCR, country by country reporting as per transfer pricing provisions, where the assessees have to disclose their capital gains entities. I just shown the structure practically in the other slide. So they are asking for information which the entities have not shared on a consolidated basis to the taxing communities. So the government, they have been asking for information for the global information where they are showing their IPs, capital gains and the structure, but they are not disclosing that. But as per the CBCR, country by country reporting, on a consolidated basis, they are required to submit their global information to the Indian tax authorities. So these are some of the 5-6 initiatives which the government has taken to eradicate the credit shopping or the tax haven planning through the DTAs, and also it is very, very important that you understand these kind of concepts. Most of you might be feeling that this is a very boring or dry concept, but once you qualify, once you become a chartered accountant, I qualified in 2009. Okay, so let's talk practically now for 2 minutes. So the point is, by 2009, I never had any of these concepts in my syllabus. At least now you guys have an elective paper on international tax. You have a lot of concepts, a lot of trainings like this. So by the time you qualify, at least you will be knowing the concepts. So please make sure that you have minimum knowledge while you are attending interviews. We are conducting campus placements in Hyderabad, and I'm sorry to say this, not even 10 to 15% of the qualified students have knowledge on international tax concepts. So it is very, very important for you, whether you are doing the elective paper, not doing the elective paper, please select articleship firms which are having exposure in international tax. It is one of the important aspects in your career going through tomorrow. So we'll go to the next topic, index versus IFRS. We'll conclude it. I know all of you are hungry, so we'll just conclude it very quickly.
Hi, hello, namaste, namaskaram, Vijayawada. How's the church? How's the church? How's the church? Why is it low? Why? I know that there is a lunch right now. We live in a country which is religiously and ethnically one of the most diversified countries in the world. One of the advantages of having so many cultures and religions in this country is that we get to taste a lot of food. And being Indians, we obviously love food, right? You all are waiting for the lunch break, I know. So, we have a variety of food culture in India. The homogeneity between the South India and North India is not the same. For example, if I have a biryani in Vijayawada, that will not taste the same with the biryani I have in Punjab. Or the momos that I have in Assam will not taste the same with the momos that I have in Mangalore. So there is a whole lot of food culture out there. In other words, you can call this the Desi food culture. Along with this Desi food culture, the world has to offer us multi-mouth-watering cuisines such as Japanese, Chinese, Italian, Mexican, continental, and the list will go on. But for us as Indians, our cravings will only be satisfied when we have our own Desi Indian food. No matter if we are given the best food on our tables, our cravings will only be satisfied when we have the Desi Indian food. Or in other words, I would say, coming to Andhra Pradesh and having biryani will satisfy me rather than having biryani in Mangalore. Because Andhra Pradesh is known for biryanis, right? So, all the food right?
Yeah, friends, I request all of you to remain calm. That is the first thing. Then every one of you will be able to listen. And I request the speaker to hold the mic close to your mouth. And also I suggest the speakers and the forthcoming speakers also in the next session, you reduce the amount of walking and try to concentrate on your presentation rather than on your walking. I also try to intervene in between. Yes, I understand presenting a proper while
is very famous in India. Anyone who can guess the name of this snack? Anyone? Any wild guesses? Anyone to guess this? I will give them the same wish you gave me. Come on, any wild guesses? Quickly. Come on, loudly. Yes? Exactly. This is known as samosa in India. So now you see the food. Samosa is known as risole outside India, and the risole which is known as samosa in India are one and the same dish. Similarly, in the financial world, where the financial transactions that take place at multiple levels. Say the transactions take place between two companies in the same state, or two companies in the same country, or two companies in the different countries. When the transaction takes place between two companies in different countries, multiple currencies are involved. These transactions have to be recorded in the books of accounts of those companies. And we, as budding chartered accountants, we very well know that these transactions have to be recorded in the books of accounts of the companies based on the generally accepted accounting principles or the accounting standards that are applicable to them. So now, what are the generally accepted accounting principles or the accounting standards? These are policy documents which are issued by recognized accounting bodies to ensure that the transactions are recorded in a similar manner throughout the countries so that the financial statements that are prepared based on these accounting standards are safe. And it is easy for the investors to compare the financial statements to make their investment decisions. In the 1970s, each country had its own generally accepted accounting principles and accounting standards. Suppose company A in India had a transaction with company B in the US. Now, when this transaction is being recorded in the books of accounts of those companies, they will be recorded in the applicable accounting standards. Company A has different accounting standards, company B will have different accounting standards. So as a result, there arises incomparability in recording the transactions. One single transaction is recorded in two different ways in two different financial statements. As a result, the investors will be confused as to why there is difference of opinions. To avoid this incomparability and bring about standardization, there was a need of one single accounting policy document which would be accepted by throughout the world. And this gave birth to IAS or International Accounting Standards, which are otherwise known as IFRS as well. But when it came to India, we basic Indians, every time we come out of the way and we have some jugaad, we have things to do in a different manner. Similarly, when it came to India, the situation देख के मेरे को एक डायलॉग याद आता है जो अमिताभ बच्चन ने दीवार मूवी में बोला था, मेरे पास गाड़ी है, बंगला है, पैसा है, बैंक बैलेंस है, तेरे पास क्या है? हाँ, and he replied, मेरे पास माँ है. So India said, हमारे पास इंडेस है. Presenting to you the topic of Index versus IFRS. So first, let us understand what are IFRS or IAS. IAS stands for International Accounting Standards and IFRS stands for International Financial Reporting Standards. These are global standards which are applicable throughout the world. Coming to IAS, these are International Accounting Standards. They were notified from the year 1973 to the year 2000 under the International Accounting Standards Committee. The main goal of these accounting standards was to bring about standardization in recording of financial transactions in the books of accounts of these companies. From the year 2001, the International Accounting Standards Committee was replaced by the International Accounting Standards Board, and thereafter all the accounting standards that were issued came to be known as International Financial Reporting Standards. These standards are very well adopted throughout the country, and if you see the adoption rate, out of the 166 accounting jurisdictions, 144 of them have adopted this IAS and the IFRS. So you see, the IFRS and IAS are adopted throughout the world, but we Indians, हमको जुगाड़ पसंद है, तो we had our own index. Index stands for Indian Accounting Standards. These Indian Accounting Standards were notified by the central government through the Ministry of Corporate Affairs, overseen by the Accounting Standard Boards of ICI, under the leadership of National Financial Reporting Authority, that is NAFRA. The Indian government adopted the convergence model, that is, the Ind AS are similar to IFRS except for some changes. Those changes are typically made to suit the Indian economy and the Indian business environment. These changes are known as the carve-ins or the carve-outs, which are discussed later in the PPT. So how was this Ind AS implemented in India? On 1st April 2015, this was adopted for the first time in India. At that time, the government rolled out the Ind AS, and it was on voluntary basis that any listed company could prepare the financial statements based on the Ind AS. Then, after 1 year of gap, in the year 2016, the government made it mandatory for the public companies having net worth of 250 crores and more or 500 crores and more to adopt the Ind AS compulsorily and prepare the financial statements based on Ind AS. From 1st April 2017 onwards, all the listed company and unlisted companies having net worth of 250 crores along with their subsidiaries, associates, joint venture and holding companies have to compulsorily prepare their financial statements based on Ind AS. So, as I told earlier, this Ind AS have been converged from IFRS. So, the numbering of Ind AS has been the same. If you see, the Ind AS that are drawn from the IFRS series have been numbered starting from 100. Suppose IFRS 1. It is the Ind AS 101. IFRS 3 is known as Ind AS 103. The Ind ASs which are converted from the IAS series, that is the International Economic Standard series, they are numbered the same way as that of IAS. That is, IAS 1 will be Ind AS 1, IAS 10 will be Ind AS 10. Now that we know what is IFRS, what is Ind AS, the difference between the IAS or IFRS and the Ind AS is known as the carve-ins or the carve-outs. So what are these carve-ins and the carve-outs? These are differences which were suggested by the government based on the economy of India and the business environment that is applicable in India. So, in case there is a deviation from the international financial reporting standards, which gives different opinion on transactions to be recorded, and in Indian business environment there is a different opinion, they are known as the carve-outs. In case there is no disclosure given in the IFRS, and there has been guidance on that in Ind AS, they are known as the carve-ins. So I will be explaining briefly 4 standards where there are carve-outs coming to IAS 1 or Ind AS 1. This standard gives the guidance on how the financial statements have to be prepared, how the items of the balance sheet, the P&L have to be represented. So, in terms of borrowings, that is long-term loans, long-term borrowings, these are borrowings which are due for after more than 12 months from the end of the reporting period. So these have to be actually classified as non-current liabilities. But in case where the loan agreement, the conditions mentioned in the loan agreement are breached by the company, this loan becomes payable on demand. So as such, this loan will be classified as current liability. But in case of Ind AS, we have a carve-out which says that even though the borrower has violated the covenants or the terms and conditions of the loan agreement, this loan can still be classified as non-current liability only if the banker or the lender has agreed not to demand the loan in the upcoming 12 months. So in case the lender agrees that within the next 12 months I am not going to demand the loan, this will be classified as non-current liability itself. Coming to the next standard, that is Ind AS 10 or IAS 10. In IAS 10, this gives the guidance on events after the reporting period. So what are events after the reporting period? Events that occur after the balance sheet date but before signing the balance sheet. So you know there is a gap between the reporting period end and the signing of the audit report. So the events that occur during this period, and it has an impact on the financial position as at 31st March of that reporting period, they will be known as adjusting events, and the effect of such events has to be given on the balance sheet and the P&L. But if such transactions do not affect the financial position at that time, they did not be adjusted and they are known as the non-adjusting events. Now, IAS 1 said that the loan which is borrowed becomes payable on demand will be classified as current liability. So, there is no such clarification in IAS 10 as to whether it is an adjusting event or non-adjusting event, because IAS 1 is completely clearly saying that it has to be treated as a current liability. But Ind AS 1 had a carve out which also resulted a carve out in Ind AS 10, and it says that if the liability becomes payable on demand, it becomes an adjusting event and it has to be recorded in the books of accounts. The effect of such transaction has to be given in the books of accounts of the company, and it has to be classified as a current liability. Coming to the next Ind AS, that is Ind AS 101, which is converged from IFRS 1. This standard gives the guidance on presentation of financial statements for the companies that adopt the standards for the first time. When these international standards or Ind AS are adopted for the first time, there are certain guidelines to be followed as to how the papers have to be presented, how the balance sheet has to be presented, how the P&L has to be presented. So, when the Ind AS or the IFRS are followed for the first time, in the previous year, I would have prepared the financial statements based on the accounting standards that were applicable to me. Now, every country has its own accounting standards. So, for the purpose of IFRS, the IFRS 1 defines the previous generally accepted accounting principles to be any accounting standards that were applicable to the company during the previous year. So any standard which was applicable to the company and they have prepared the financial statements based on those standards, they can converge to IFRS and prepare the financial statements under those standards. But coming to Ind AS 101, since it is only applicable to India, and in the Indian scenario, we had only accounting standards that were applicable. So Ind AS 101 brings a carve out and says that the previous gap is defined only as accounting standards. So if a company had prepared financial statements under any other standards other than accounting standards, will not be able to convert to Ind AS regime. Coming to the next Ind AS, that is Ind AS 103, which is converged from IFRS 3. This gives the guidance of business combinations. Business combination simply means the mergers and acquisitions, takeovers and all that. So two companies are being merged or acquired or takeover, all that things happen. So we know that when two companies merge, either it will result in a goodwill or it is going to result in a capital reserve. Any one of the scenarios is possible. When it comes to IFRS says that in case you have a capital reserve, which in other words is known as the gain on bargain purchase, it has to be recorded in the P&L, that is the profit and loss account. But Ind AS 103 has a carve out and says that if there is a capital reserve, it does not have to be recorded in the P&L, but it has to be recorded in the other comprehensive income part of the profit and loss account. Or if there is a certain clarity that gain on bargain purchase is clearly visible, in that case the gain on bargain purchase will be recorded in the equity portion of the balance sheet. So these were the carve-outs and the carve-ins. Concluding my session, no matter whether it is the samosa on the plate, it will give us the best taste because it is from India. Similarly, for the investors, when the two financial statements are given, if they are prepared based on the accounting standards that are similar, it will be easy for the investors to compare them. Thank you one and all for being the patient audience. I would like to thank the of SIS and the Sikasa student community for providing this opportunity. Thank you once again.
I think this is one of the complicated topics that even 20-year-old CFOs or 20-year-old experienced people, struggle to understand. So when this concept was introduced back in 2016, 2017, when the first time adoption of India's was going through, there was a lot of confusion, there was a lot of challenges in understanding the global standards. So I'll just quickly run through. I'll just take 5 minutes and I'll quickly run through the next slide. So the point is how it got incorporated into India. So the point is there is an international accounting standard committee, there is a systematic interpretation committee, and the IFRS committees who have sat together from 1973 onwards till 2001 and struggled and got this done. So the point is, if at all you are taking IFRS very light, guys, please focus. Please, this is an important topic. All of you will be chartered accountants tomorrow. So please behave and please listen to the topics very seriously. What I'm trying to say is, they're all of equal standard. Those who are sitting in the behind row, you guys and these guys are of the same standard. Please question and evaluate yourself. They are in a situation to explain, stand before 300 people and talk. So you are still behaving like college students. So if you have to pass CA exam with this kind of conceptual knowledge, don't blame the institute again for the pass percentages. So please focus. There is a very good session organized by the Sikasa. So if you are not taking this seriously, then it's up to the loss of your own good. So please behave and listen to the concepts properly. So this IFRS Advisory Council and Accounting Standard Advisory Forum have done a lot of work and implementation strategy. So the structure of the IFRS Foundation itself, Indian government was worried, and the Indian adoption of any law, so it has to go to the parliament, it has to go to the Ministry of Corporate Affairs, NAFRA, MCA, everybody got involved. So they started taking the things into consideration and they analyzed these 16 IFRS standards, 29 international accounting standards and the interpretation committees. So all this was put together and brought into India as Ind AS. So tomorrow when you are signing any listed entity balance sheets, when you are signing any 250 crores above net worth companies, this is very, very important for you to understand what are the changes between the regular accounting standards versus the Ind AS. So the point that we have to understand is the basic differences between the accounting standards and the IFRS and Ind AS. So principle based IFRS are mostly concentrating on the P&L impact, but Ind AS mostly concentrates on the balance sheet impact. So that is the core area. Substance over form importance is given in IFRS, but Ind AS always focuses on the extensive controls and disclosure requirements. So the point is, the fundamental concepts of these 4-5 things have to be understood while you are reading the differences and understanding the concepts of IFRS and Ind AS. There is an international diploma course in IFRS, post-qualification course on IFRS connected by the institutes. So once you qualify, then you will understand, once you are about to sign balance sheets on Ind AS, then you will understand this seriousness. The point is that in globally also, 149 countries have adopted this particular concept of IFRS. India, as he rightly mentioned, we are craving for our desi food or desi stuff. So the point is they have changed this to Ind AS and they have done this. MCA has notified this in 2015 with a phase-wise implementation. So the next slide. So go to the next slide. Next. This is the phase-wise implementation. So in 2016 and 17, they only said companies which are more than 500 crores for the first phase of implementation. In 2018, they started saying, slowly the listed entities have to present their balance sheets in Ind AS. Third phase in 2018 and onwards, they said 500 crores and all scheduled banks and insurance companies have to start. Now we are at this phase 4, where net worth of more than 250 crores and 500 crores have to present their balance sheets in Ind AS. This is very, very important, and companies which are big enough outbound, especially holding from India and going abroad, these companies which are having 250 crores worth net worth, they have to systematically present their balance sheets in Ind AS because of the global requirements and global standards. So this is how the phase-wise implementation of Ind AS has happened in India. Now, what is the difference between adoption and convergence? See, the point is, adoption is straightforward induction of the global IFRS program. But convergence, they have tweaked that adoption. What did they tweak? He was just mentioning about carve-outs and carve-ins and examples, and he brilliantly presented it in one word. I don't know how many of you listened to that 4 slides that he has just mentioned, but he has brilliantly put forward with single words the entire concept. If you have to go through those chapters of the carve-outs of 3 chapters that he presented, it will take minimum of 1 week for each chapter for you to understand. He just presented it in one word. That's why I was asking how many guys have listened in the back. So the point is, this sentence of Ind AS is equal to IFRS minus carve-outs and carve-ins and removal of options is very important for you to understand the convergence concept. So what is the difference between direct adoption and this convergence concept that India has adopted is, they have plucked out some carve-outs out of IFRS, they have removed certain things from the global standards, they have included their flavor in terms of carve-ins, and they have brought in their own concept of Ind AS. Next slide. So, he just presented 3. There are almost around 9 carve-outs and 1 carve-in. But the overall presentation, I don't want to go into details, but I just mentioned that the focus of India is on the balance sheet. They are not on the P&L. Can anyone explain why it's not on P&L? They want to avoid tax. So mostly they want to take everything into capital reserve. They want to take everything into assets. They want to take everything into non-current liabilities. So he mentioned 3 out of 9. But one important thing, as a common control, what people are currently worried about is if the holding company, which is having this 250 crores or 500 crores of turnover, if they are adopting Ind AS, then the subsidiaries also will compulsorily be required to adopt Ind AS. So that particular common holding has been implemented in India, but the joint ventures and associate companies have been excluded from this requirement. So most of the infra companies, which are directly or indirectly controlled by the political parties, they have been avoided from Ind AS compliance just by a single word of joint ventures and associates being removed from the Ind AS requirements in spite of the common control. Next slide. The foreign exchange fluctuations is one important thing that you have to understand. I don't know whether most of you would be knowing accounting standard 11, where the capitalization, the fluctuations have to be taken when it has to be considered as revenue, when it has to be capitalized into the plant and purchase equipment. But as per Ind AS requirement, mostly they are given the option to continue the policy as per AS 11, which is a very, very important thing as far as MNCs and international companies is concerned. They have given that flexibility, but however, in IFRS, they have removed that flexibility. They have never given that flexibility. They want you to recognize that and take a hit into the P&L. So IFRS is mostly about P&L. Ind AS is mostly about balance sheet. Ind AS is mostly about the disclosure requirements. IFRS is mostly about substance over form. This is the correct thing. IFRS is mostly correct and it gives you the right perspective. But you have to understand the Indian perspective to sign balance sheets tomorrow. So this is the overall thing that I wanted to summarize on India's and IFRs. Any questions, any suggestions from the crowd, we will be more than happy. I think as a feedback for all three of you, you've done brilliantly well. I think for your age, for your maturity, you have done fantastic.